Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week, a week where everyone will still be talking about what happened last week when the Fed and Jerome Powell came out with their latest interest rate hike, plus gave a press conference with a lot of details. Let's get into it. Well, by now you've heard that the Federal Reserve increased their key interest rate by 50 basis points, which is 0.5%. And they also gave a lot of details of how they came to that conclusion and what they're looking for on the horizon in 2023. We've been telling you for weeks that what they say is going to be more important than the decision itself, and here's a quick breakdown of some of those key comments. Number one, Jerome Powell said that ongoing increases are appropriate to maintain a substantially restrictive policy for some time. He then acknowledged that the housing sector has deteriorated significantly. Also, that GDP is well below its expected growth rate. The labor market is still out of balance. The Fed will have to raise rates higher than they initially anticipated and keep them there longer than they hoped. There have been zero discussion of cutting rates in 2023. And when asked if they would be sticking with their target of 2% inflation, he said yes, they have no intention of raising their inflation target expectation in order to hit that target. All in all, this is confirmation after confirmation that they are intent on staying the course and doing everything they can to combat inflation, no matter what that looks like and whatever lies in the wake of those choices. Now, with all that happening to kind of close out the end of the year, this week's market data is a little bit in the shadows of last week's Fed comments. However, on any normal week, this set of data would all be headliners. First of all, on Tuesday, you get building permits and housing starts. Both of these are key indicators of either the growth or contraction of specific industries, such as construction, real estate, mortgage, among others. Wednesday, we get the consumer confidence number and existing home sales. They're different numbers, but especially this time of year, that consumer confidence number is really intriguing. Thursday, we'll get a preliminary look at what the final GDP number would look like, as well as another unemployment reading. And last week, the Fed kind of gave us a primer that these may not be as expected. The real surprise would be if both of them came out better than expected. And on Friday, we get core PCE, the personal consumption expenditure, which for half the year I've been telling you the Fed's been using as the key barometer to measure their fight against inflation. To many people, this reading is the true measurement of what inflation is at the individual level on average across the nation. But here's a little warning about averages that I learned years ago that I want to share with you today. Be careful about averages, because I once knew a man who died trying to cross a river with an average depth of 4 feet. And yes, that's just a metaphor. So what does that mean for mortgage rates this week? Well, last week mortgage rates were all over the place during the Fed press conference and then afterwards, but they ended up ending the week kind of where they started. This week they're starting where they ended, but it looks like they're going to be stuck in this trend and this range to end the year because, again, this week's set of economic data is clearly in the shadows of last week's press conference, and we're also ending the year, which is typically slow in the markets around this time. So I wouldn't expect a lot of volatility, of course, unless we get something out of the blue, completely unexpected that happens that makes the markets get the jitters. Otherwise, it should be par for the course for the rest of this week and also into the final week of the year. And more broadly, until the sentiment of the Fed has changed and the technical reasons for the decisions that they're making have been altered, this is going to be a day-by-day, week-by-week, month-by-month case for rates moving forward into 2023. And lastly, there is no show next week. Next Monday, of course, is the day after Christmas. It's also a bank holiday, and there is little to no economic data of value next week that's going to change the markets in between Christmas Day and New Year's Eve. But that being said, if you have any questions, we're still available and you can reach us. We'd like to be the first to tell you Merry Christmas and Happy New Year. We will still be open the week between Christmas and New Year if you need to reach out. As always, please like this video, share it with someone you know, love, and trust, subscribe to the channel, and turn on notifications so that every time we drop a new video, you hear about it first. If you specifically have questions about your situation and you want to talk to one of our loan officers, please send us a direct message. You can comment on this video. You can also reach out directly to your loan officer by calling them, shooting them an email, or even a text message. Thank you so much for watching. We'll see you again next year.